Okay, I'm going to continue from where I stopped last week. We are still looking at directors and board structure. Okay, I know this is the third lecture on this topic, but this is an area which is very, very important in corporate governance, directors and board structure. Okay, so today we're going to look specifically at members of board committees. Okay, we have spoken in the last lecture about the three important board committees, which is the nomination committee, remuneration committee, and the audit committee. Okay, so these are three important board committees. Okay, members of board committees, the directors, they are directors. Either the board committee must be dominated, meaning they are the majority, if not exclusively of INET. INET stands for Independent Non-Executive Director. So that is the guidance given by the regulators. In the context of Malaysia, this is the Suruhanjaya Security Malaysia or Securities Commission of Malaysia. So they should be either dominated, meaning they are the majority, if not exclusively composed or made up of INET, Independent Non-Executive Directors. So in terms of skills and knowledge, they should be financially literate. When we say financially literate, this means that they can read and make sense of financial data, statements and information. So very important, if you're a board member, you should be financially literate, meaning you have some background in accounting and finance. Okay, so when you're given the financial statements, so at least when you go through, you have some idea what's going on in the company. Not when you get the financial statement, you just look blank. Okay, you don't know what's going on. So this is in terms of skills and knowledge. You have to be financially literate, able to read and make sense of financial data, statement, and information, and then must have access to information and professional advice. So meaning that if something is beyond your expertise, you don't have a background in this area, so you must be able to get this professional advice from outside at the company's expense. For example, if something comes to you, some document comes to you, you read it and tell yourself, oh my, this has a lot of legal implication. I don't have any background in law, so I will have to consult the lawyers. Okay, so of course you have to pay for that, but this one, the company will have to foot the bill. Okay, so directors, they have to be either majority INET or wholly INET. They have to have the right knowledge, skills, financially literate, and you must have access to information and professional advice. Okay, why are these committees important? Why are they important? First one, they assist the board of directors to make decisions. Okay, they assist the board of directors to make decisions. They play an advisory role in specialized areas, for example, tax, accounting, reporting standards, risk management, etc. Okay, sometimes the boards, they don't have any background in these areas. They might be appointed to the board because they are family members, not because of any particular skill or any particular reason. It's a family company, so they're on the board. So this way, they're depending on you, give an advisory role, for example, in areas like taxation, accounting, reporting standards, and so on and so forth. Because you are studying all these modules in your accounting and finance degree. Okay, you're doing taxation, you're doing accounting, you're doing financial reporting, and so on and so forth. Okay, they have to be a small size. Okay, these board committees, they should not be too big. So the recommendation is between 3 to 5 members. If it is too big, it's very difficult to meet. One person is free, the other one is not free, and so on and so forth. So it's more manageable. It's more manageable when the size is small. So they can concentrate their time and effort. They can focus. Okay, if it's too big, it's difficult to focus. So they can focus, they concentrate their time and effort on one specific area, and they can meet more often. They can meet more often if they are small. So the advice is that it should be at odd numbers, 3 or 5. Okay, unless the company is very big, then maybe 7. But 7 is not normal. It's between 3 to 5. Okay, then the other reason why these board committees are important is they allow the board to focus on strategic tasks. I've said this before. I think I've stressed on this many times already. So the board has to focus on the strategic issues. Strategic issues is the responsibility of the board. Operational matters is not the responsibility of the board. I think I have repeated this many times already. So delegate issues or matters relating to remuneration, board succession, nomination, audit, risk management. So all of these will be taken care of by the respective board committees. So as I said before, there are 3 board committees that we need to keep our focus on, which is the nomination committee, remuneration committee, and audit committee. Okay, so these are the areas that we focus on: remuneration, board succession, nomination, audit, risk management. Okay, now let's look at one particular committee called the nomination committee. If you just go through the annual reports of any company listed on Bursa Malaysia, just go to the website of Bursa Malaysia and just download the report. You will see they will have a nomination committee. So what is the role of the nomination committee? What is their job? Okay, so their job is to propose new members, new nominees for the board, and then assess the performance of the directors on an ongoing basis. So this is the job of the nomination committee. Okay, they will make nomination for new members to join the board. Okay, and then they will bring it to the AGM. AGM. They can only nominate. The shareholders will decide whether they agree or they don't agree. They will vote on it at the AGM, annual general meeting. So what is the function of the nomination committee? Their function is to recruit and retain the best available executives and non-executive directors. NED stands for non-executive directors. They want to recruit and then retain the best available executive and non-executive directors that identify core competencies, skills, and other qualities required of INETs. So what are the core competencies, skills, and other qualities required of INETs? INET stands for Independent Non-Executive Directors. So this is the job of the nomination committee. Recruit and get the best people to the board, and then they need to identify what are the core competencies, skills, and other qualities required of INETs. INETs is the Independent Non-Executive Directors. So now we look at the process of nomination. What is the procedure? What is the procedure and the process for nomination? First requirement is that it must be formal and transparent. It must be a formal process and it must be transparent. So all existing and current directors should be required to submit themselves for re-nomination and re-election every 3 years. So meaning that you can't be sitting on the board forever. Okay, so you have, after every 3 years, you have to submit yourselves for re-nomination and re-election every 3 years. So all existing and current directors should be required to submit themselves for re-nomination and re-election every 3 years. So decision, who they just nominate, the decision will be the bring to the AGM, and then the shareholders will decide. So the responsibility of the board of directors after considering the nomination committee's recommendation. So they just make a recommendation. So this the board will bring to the AGM, annual general meeting. Okay, and the shareholders will vote on it. Sometimes they might agree, sometimes they may not agree with the nomination. Okay, so this is how the nomination process works. So it must be a formal and transparent process. Okay, these are the best practices for the nomination committee. The first one is the balanced board. So what do we mean by the balanced board? So they have to review the board structure, size, and composition to make sure that the right candidates are selected at the right time by evaluating the skills, knowledge, and experience required, meaning that the candidate must have the right skills, knowledge, and experience. So this is what they mean by balanced board. So to review the board structure, size, and composition, to ensure that the right candidates are selected at the right time by evaluating the skills, knowledge, and experience required. So there has to be a proper mix of skills, knowledge, and experience. That is what they call a balanced board. To review the board structure, size, and composition, to ensure that the right candidates are selected at the right time by evaluating the skills, knowledge, and experience required, meaning there is a proper mix. That's what they call a balanced board. And then the second area is board succession. So we just saw it in the tutorial just now. This is a very critical aspect in corporate governance, board succession. So meaning that to groom existing top or executive managers for the CEO post. So you have existing managers to groom them to become the next chief executive officer. Okay, so you got to have a process in place, meaning that if, like we just saw just now in the case study, when the finance director left, there was nobody. In the case of the Tesco, the finance director left, and then the position was vacant for so long because the company did not have a proper succession plan. Okay, so this is another very critical area in best practice in corporate governance. And then to identify external candidates for the non-executive chairman post. Okay, so this position, non-executive chairman, must be held by somebody from outside the company. So to identify external candidates for non-executive chairman post. So this is the best practice. So we need to keep in mind what is the role of the nomination committee, how do they carry out their function, what is their function, what is the procedure that they have to follow when they do the nomination. Okay, it should be a formal process, it should be transparent, and then they just nominate. Okay, so then the board of directors will bring these candidates, the names suggested, to the AGM for the shareholders to vote on the names, whether they agree, whether they will vote on it. Sometimes they may agree, sometimes they may not agree. Okay, then we need to have a balanced board, okay, to make sure that you get the right candidate, the right time, with the right skills, right knowledge, experience, and so on. And another aspect that the nomination committee also needs to keep in mind is what is called board succession. So to groom existing top or executive managers for the CEO post. And in the case of the executive chairman's post, they need to identify external candidates, people from outside the organization. Okay, this is all part and parcel of best practices of the nomination committee. So as I mentioned before, these are some of the important board subcommittees. So now we are looking at the nomination committee. So keep in mind, the nomination committee will only nominate. Okay, they will nominate this person. After doing their search, they found this candidate. He's the best match for us. So we nominate this person. And then the board will bring up the name to the AGM, annual general meeting. So at the end of the day, it is the shareholders who will accept the nomination, or if they don't like, they can reject the nomination. Okay, so their job is to just identify the best candidate, identify the right candidate who has the right experience, the right skills, the right knowledge, and so on and so forth. They call it the right match for the company. Okay, he needs to have the skills that we are looking for, and he can come along and be a team player, be part of the board member. Okay, so the other aspect, as I've said quite often already, this is another critical area, is board succession. We just saw in the earlier tutorial just now the case of Tesco. Okay, the finance director just left, and then there was nobody to step in to fill his job. Okay, in the board members, none of them have any background in accounting and finance. So when the finance director left, so they were left high and dry. Okay, so this should not happen. Meaning you've got a board succession plan. If so and so leaves, so this one will step into his job. Okay, and likewise for the very important position of chairman. The chairman, you need to identify external candidate for the non-executive chairman post. This position is important because this person will chair the board meetings. And when there's a tie, meaning 3 people for, 3 people against, so he will have the vote, okay, to break the tie. Tie means that they can't agree. Okay, so there's a tie. So the executive chairman, non-executive chairman, will come in with his vote. Either he support one side or support the other side. So that's why the best practice says that you've got to have in odd numbers, okay, odd numbers, 3, 5, or 7. That's the best practice, okay. Either you have 3 members in the board, or 5 members, or 7. Okay, so this is the nomination committee. Next is the remuneration committee. Now, what's the job of the remuneration committee? They evaluate the directors and CEO's performance and recommend the appropriate remuneration package and benefits to the board of directors for approval. Okay, this is a very sensitive area because this is what they get. And in Malaysia, if you just look at the annual reports of the companies, in the directors report section, you will see the details of the remuneration. Remuneration is their package, their pay package, their perks, their driver allowance, travel allowance, and whatever allowance, the total package is called the remuneration, their remuneration. So who decides on it? It is done by a committee called the remuneration committee. So they evaluate the directors and CEO's performance, and then they will recommend appropriate remuneration package and benefits to the board of directors for approval. So that is their job, that's their role. So how do they carry out their role? So they need to have, again, a transparent and formal procedure in developing and accessing the level and makeup of compensation that would be sufficient to attract and retain talented and good caliber executive directors and CEOs. So as I've said before, you want to get the best people, okay, you do your head hunting. Okay, of course, there are many job search companies out there, okay, HR companies out there who can help you. But at the end of the day, you have to give the appropriate remuneration. As they say in English, if you pay peanuts, you get monkeys. So you want best people, you have to make sure you are paying what the market pays. Okay, if another company which is similar to you in terms of performance, in terms of turnover, in terms of asset valuation and so on, they are paying so much for their board members. If you are paying only so little, you will not get the best people. Okay, so you have to carry out a transparent and formal procedure in developing and accessing the level and makeup of compensation. Keep in mind, it must be sufficient to attract the best people, sufficient to attract and retain talented and good caliber executive directors and CEO. You have to carry out this job very carefully because you don't want to pay too little, but at the same time, you don't want to pay too much. So that's why they say avoid excessive pay package for EDs and CEO. This is another area in corporate governance. Sometimes public, you can see, especially now in social media, publics are very, shall I say, very proactive. Okay, they look at the company, the performance is not so good, but when they look at the back of the annual report, especially the director's report section, wow, they see the director getting 500,000, 2 million, 3 million, 4 million, so on. If you don't believe me, just take any big company in Malaysia, check it out for yourself. Okay, what is the remuneration package like? Okay, some of them are getting millions, 4 million, 5 million, and so on and so forth. You can check out, for example, Genting, one of the big companies, Genting, Public Bank, CIMB, Maybank, and so on and so forth. Check it out for yourself. Okay, so remuneration committee, one of their jobs is to avoid excessive pay packages. Okay, cannot give too little, you won't get the best people. If you pay, don't pay too much, because now there's the issue of remuneration linked to performance. Company not doing well, share price is declining, share price is dropping, and so on and so forth, but still they are getting the very high remuneration, meaning the remuneration is not linked to performance. So this become a very sensitive issue, and you can see all kind of comments in social media. Okay, in fact, as I mentioned before, I don't know whether I mentioned in this lecture class or tutorial class, a few years ago there was an issue with FGV, Felda Global Ventures, and then they had the shareholder were not happy. They called for an EGM, not AGM is once a year, but EGM can be called anytime there's an important matter to discuss. EGM stands for Extraordinary General Meeting. It can be called anytime, it's up to the shareholders, so long as they have the numbers, they have the quorum. If they have the quorum, they can call for the EGM anytime. And they wanted to discuss an urgent matter. What was the urgent matter all about? They were not happy. Company share price dropping, company not performing well, but yet the directors were getting a high package, salary, bonus, and other perks. So in fact, they passed a resolution during the EGM. They wanted to stop all the benefits and perks to the directors. So again, this is the right of the shareholders. Okay? At the end of the day, company belongs to the shareholders. So if the company is not performing, and yet they keep drawing a very high pay package, not just pay plus travel allowance, entertainment allowance, this allowance, that allowance, driver allowance, car, and blah blah blah, not happy. Okay, so very important aspect, very sensitive aspect. Remuneration linked to performance. People will not make noise. Company doing well, okay, they're happy, share price going up, their dividend going up, year after year going up, they will not complain, they will not make noise. It's only when the company not doing well, and yet when they see the annual report, they see the director report section, the remuneration is still so high, and then they will make noise. Okay, so what is the process? Again, like the earlier nomination committee, there is a process to follow. So the remuneration committee recommend to the board of directors the appropriate remuneration package. As I've just said, if you pay peanuts, you get monkeys. So you want the best people, you must pay what the market pays. Cannot be too much, cannot be too little. Cannot be over, cannot be under. So you need to identify the appropriate level. So for this purpose, you can engage or consult professional advisor or HR consultant. There are many in the market. They will give you the right advice, okay, so that you don't overpay or underpay. Okay, you may not have much experience in this area, so you can engage or consult professional advisor or HR consultant. Now, how for making decisions, the executive director and INEDs, independent directors, should abstain, meaning they should not take part in the meeting which is discussing their own remuneration, meaning they should get out of the meeting, so that they do not influence the other members. So this is best practice. So if the meeting is discussing the remuneration of executive directors and INEDs, and they are sitting in the meeting, they should abstain, meaning they should leave the meeting, so that they don't influence the other board members, so that they can make the decision independently make the decision. However, at the end of the day, the board of directors will make the final decision on the remuneration package of INED. INED, as I've explained before, stands for Independent Non-Executive Director, including the non-executive chairman. Okay, who makes the final decision is the board of directors. Now, for the purpose of being transparent, so there's no secrecy, it's best practice in corporate governance, it should be transparent. So this must be disclosed. So where can we find this information? We can see this in the director's report with director's section, director's report within the annual report. Within the annual report, you have a section called the director's report. So within the director's report, you will see who are the members of the remuneration committee. Okay, are they independent? Okay, are they following a transparent process? Okay, are they, like, for example, making decisions about their own remuneration and so on and so forth. So all of this must be disclosed. You can see these details in the director's report within the annual report. Okay, so this is the procedure to follow, the process to follow to ensure that the whole process is above board. Above board meaning that it is transparent. Okay, there's no bias. There's no, like, they are discussing about their own remuneration. That should not happen. Okay, that should not happen. Okay, the next committee that we need to look at is audit committee. These are the three board committees: nomination committee, remuneration committee, audit committee. Now, this is a very important committee. Why do I say it's a very important committee? These people are, you can say, they are the watchdogs. Okay, they are the watchdog for the shareholders. So audit committee is a very important committee. They have a lot of things to be looking at. So what is the requirement? So as far as Bursa Malaysia is concerned, okay, this is mandatory. Mandatory meaning you must have it. If you are going to be listed in the Bursa Malaysia, you must have this audit committee. It's a legal requirement. It's a legal requirement. It's required by law to have the audit committee. Okay, so company can be charged and taken to court. The earlier one, there was no requirement. Did I mention about legal requirement here? Did I ever mention about legal requirement in this, what do you call, But this committee, nomination committee, did I say it's a legal requirement? Okay, I didn't mention, right? I'm sure I didn't mention. How about remuneration committee? Did I say it's a legal requirement? No, I didn't say that. Okay, but when it comes to this committee, it's a legal requirement. Legal requirement means it's required by law. Okay, so if you don't have it, then you can be taken to court. Okay, so it can be charged in court. So just said earlier, this is a very important committee. Probably of the three committees, this is the most important committee because they are there like a watchdog to take care of the interests of the shareholders and also the minority interests. Okay, shareholders and the minority interests. So what is the requirement as far as the makeup of the composition is? The requirement is that there should be a minimum of 3 members. Minimum of 3. They don't mention what maximum, but they say it must be minimum of 3. Majority must be INET. So meaning if you have 3, 2 must be INET. 1 can be an executive director. But in fact, now the recommendation in many big companies for best practice, all members are INETs. Meaning all 3 are INET. INET is independent non-executive directors. These are people who don't have a stake in the company. So whatever judgments they make are independent and in the best interest of the company, minority shareholders. They don't look at everything from their own self-interest. This is a serious issue. I mean, there have been many issues. I think the recent one is the subordinate case, which I shared with you in Times. I don't know how many of you bothered to read it, but it's a very important case. If you go through that case, you'll see there are lots of issues there from a corporate governance perspective. Okay, from a corporate governance perspective. So the requirement is audit committee must have at least 3 members. Majority must be INET, meaning if you have 3, 2 must be INET. Better still, all 3 lah. Better still, but at a very minimum, there must be 2. So in case there's a what do you call it, a contentious matter coming up for discussion, so if it's put to vote, so you know that you have the majority. Okay, 2 versus 1. Okay, and another very important requirement: at least 1 member must be a member of MIA. This is good news for us because especially for you guys, you are training to be accountants. I'm guessing because you are doing accounting and finance degree. Okay, I guess you are training to become an accountant. So if you really want to become a full-fledged professional accountant, you have to go on and do a professional qualification. It could be ACCA, CIMA, ICAEW, MICPA, whatever. That doesn't matter. And then you sign up with MIA to become a professional accountant. MIA, as I've explained from day 1, stands for Malaysian Institute of Accountants. So, meaning that at least 1 member of audit committee must be a professional accountant. At least 1 member. But if you look at good companies which practice good corporate governance, majority of the members of the audit committee are MIA members. If they are MIA members, means they have a background in accounting. They not only just have a degree like you guys, and then you have a professional qualification to become a member of MIA. So that means they know when you're discussing accounting matters, finance matters, they know what's going on because they have the background. And the chairman or chairperson, the chairperson of this audit committee must be an INET. The chairperson must be an INET. Because when it comes to a vote, let's say there's a tie, right? There are 3 people, 1 for, 1 against. This is called a tie. So the chairperson has the breaking vote to break the tie. So to make sure that he or she, chairperson, is taking care of the company's best interest, so the recommendation is that he or she must be an INET, independent, non-executive director. Okay. So again, I repeat what I just said just now. This is a very important committee. It's required by law. It's a legal requirement, and also a requirement of Bursa Malaysia, BMLR. BMLR stands for Bursa Malaysia Listing Requirement. It's mandatory. Okay, companies which don't follow, the action can be taken against them. Okay, so majority of the members of the audit committee, the recommendation is to have in odd numbers, 3, 5, or 7, but minimum should be 3 members. and the majority must be INET, independent non-executive directors, and at least one member of MIA, Malaysian Institute of Accountants. And the chairperson of this committee must be an INET, independent non-executive director. Okay, so what is the role of this audit committee? Since I just said just now, it's a very important committee. So what exactly is their role? What exactly is their function? They have to implement and support the monitoring functions of the board of directors. Okay, to implement and support the monitoring functions of the board of directors. That's their role. To implement and support the monitoring function of the board of directors. Okay, that's their role. And how do they do it? First of all, they have to improve the disclosure practice and transparency. It's a very critical area in corporate governance. Improve disclosure practices and transparency of financial reporting, and to make sure that when companies prepare their financial statements, they adhere to accounting standards. In the case of Malaysia, we have the Malaysian Accounting Standards Board, MASB. MASB stands for the Malaysian Accounting Standards Board. To improve the disclosure practices and transparency of financial reporting, and to adhere to accounting standards prepared by MASB, Malaysian Accounting Standards Board. That's the first function of the audit committee. The second one is to ensure adequacy of internal control systems and risk management program. Now, you will find that if a company is a good company, okay, they have put in place a strong internal control system. I won't go into the details of this because this will be covered in the audit and assurance module. I think you will be doing it in SEM 5, if I'm not mistaken, SEM 5. Okay, so I don't want to go into the details of it, but if it is a good company, they will have a very strong internal control system. Okay, system of checks and balances, and also risk management program. Very, very important. If it's a good company, they would have it. Okay, they will already have it in place. Internal control system and risk management programs. All of this is being supervised by the audit committee. So they have to make sure that the company has put in place adequate internal control system and risk management program. Risk management programs are programs that identify risks. They identify the risks before the thing happens. We don't wait for the thing to happen, then we go and try and fix the problem. So we have put in place the appropriate risk management program. They will already identify and tell you early upfront, okay, this is one thing possibly can happen. So make sure you are aware of this and have a plan B. Should this happen, you have a plan B. Okay, this is called risk management program. So what are the functions of the audit committee? Now, if you remember, again, I go back to that slide from, I don't know how many weeks ago, okay, where we had the external stakeholders, the internal stakeholders, and on the extreme right, if you recall that slide, we had the external auditors. External auditors. So they're also very important part of corporate governance, okay, internal stakeholders, external auditors. So what's the function of audit committee? Firstly, to review with the external auditor the audit plan. So auditor will come with his plan. Sit down with the audit committee and we go through. Okay, so we will give our comments. Audit committee will give our comments. Okay, this is the audit plan, your plan. So I think you should focus more time on debtors, or focus more time on receivable, focus more time on stock, focus more time on asset, focus more time on intangible, whatever. Discuss with them the detail. And to review with the external auditor, evaluation of system of internal accounting control. I just explained just now. Very, very important. Okay, if company is a strong company, a good company, they have a very strong system of internal control. So meaning that this system will pick up issue or problem before it arises. Will identify problem area. Not wait for the thing to happen and then you react. That is called reactive. The thing happened, then you react. That's reactive. This is proactive. Proactive means they haven't happened yet, but you have in place the system. Early warning system. Okay, we call it the early warning system. evaluation of the system of internal accounting controls. And then once the auditor has done all his external auditor, and I'm talking about the external auditor, once the auditor has done his work, he will come out with the audit report. Then before he makes it official, he has to discuss with the audit committee. These are my findings. These are my findings. Now, if I go public with this might not be good for your image, for the company's image. So I think I go back to the Serba Dynamic case, right? KPMG didn't sign off on their report. Because they're a listed company, if they don't sign off on the report, there's a lot of implication. Public and stakeholder will be asking, is there something wrong? Why the auditor don't want to sign? So we don't want to let it get to that stage. Okay, a good company don't want the issue to go to that stage. Solve the problem early. So sit down with the audit committee and discuss. These are my findings. Can you fix this? Can you fix these problems before I sign my audit report and make it public? So this is the job of audit committee. Sit down with the external auditor. Okay, these are the problems we have identified. Let's see how we can fix it before you sign off the audit report. Okay, we don't want, like I just mentioned, the case of Serba Dynamic, KPMG refused to sign the audit report. Okay, right. And then the assistance given by the company's officers to the auditor. Sometimes an external auditor comes to our place. Okay, some of the staff don't want to cooperate. It happens quite a bit. Okay, either because they're lazy or because they want to hide something or whatever. So then the auditor, external auditor, has this channel. Come meet the audit committee and tell them, I asked for this file, they don't give me this file. I asked for this, they don't give me, and so on and so forth. So he can complain to the audit committee. And then the internal auditor, don't forget, all big companies have an internal auditor, in-house internal audit department. Okay, on top of the external audit, they also have their own internal audit. So the internal auditor also has to come before the audit committee and to discuss the scope of his work. What are his results? What are the problems he found? What are the reservations he has from his audit? Okay, so basically this is what we can call the port of first call before the issue goes out to the public. So audit committee will go through and see how we can fix this problem, how we can solve this problem before it comes out to the public. Now, especially with all the social media, you have to be very, very careful. Okay. Before it's already out on the Facebook or Instagram or Twitter or whatever. Okay, so functions of the audit committee: the balance sheet and profit and loss account of company. Okay, they will go through. Okay, before sending to the directors for the signature. So these are the people, as I've just said before, the MIA members. Okay, at least one member MIA. In many companies, more than one. Most of them are MIA members, meaning they have a background in accounting. So they have a background in accounting, they can go through the balance sheet, profit and loss account, and before sending to the directors for their signature, let's identify, is everything proper? Are there any RPT, related party transactions? This is this is what we call transactions not at arm's length, okay? Transaction meaning selling company assets to a related party below market price. That's an example of RPT. RPT stands for related party transaction. Okay, this is a very valuable asset, belong to the company, but it's sold to someone, related person. A related person sold not at market price, below market price. This is called a related party transaction. So we need to pick it up before the external auditor pick it up. And then quarterly and year-end financial statements. So if you're a listed company, you have to prepare financial statements every quarter, every 3 months. It's the requirement of the Bursa Malaysia. If you want to be listed, you have to do it. Otherwise, you'll get a show cause letter from the Securities Commission of Malaysia. Okay, the regulator is the Securities Commission of Malaysia. They will send you a letter, a warning letter. Okay, so every 3 months you have to prepare your financial statement, and also at the end of the year. So as you can see, 1, 2, 3, 4, 5, 6, 7, 8. So it's quite a lot of work for the audit committee lah. That's why I just said just now. Of the 3 committees, the nomination committee, remuneration committee, audit committee, this is the most important committee. Firstly, it's required by law, okay, and their members must be accountant, if majority of accountant, if not all accountant, and they must be INET, independent non-executive directors. Okay, and they play a very important role to support the monitoring function. Adequacy of internal control system, adequacy of risk management. Okay, and then sit down with the external auditor to discuss his audit plan. What was your evaluation of internal control? What is in your report? Okay, before you sign off and make it public, is there any issue that you have highlighted? Can we solve the problem so you don't need to talk about it in your audit report? And then if you're having any problem, auditor having a problem, no cooperation from the staff, you can come to the audit committee and complain, and then they will do what they have to do, and so on and so forth. And not forgetting also the internal auditor, in-house internal auditor also has to come before the audit committee, discuss their work, what are their findings, what are the problem they found, what are their reservations, and so on and so forth. Okay, and then go through the balance sheet, profit loss account before you send to the directors for the signature. Meaning once you send to the directors have confidence, okay, this has been checked by the audit committee, I just sign. So as I mentioned before, the directors sometimes they are very old people. Okay, they are there because they are related to the boss, they're related to the family. Maybe they don't have any background in accounting, so they're relying on you to do the job. So the things you need to pick up are RPT. RPT is related party transaction. When you have like holding company and subsidiary companies, sometimes one company selling to another company, asset at below market price. Okay, so why did this happen? Is there an element of some hanky-panky going on? Okay, most of the time it's selling company assets to a related party at below market price. It's not to the benefit of the company or the company shareholders, it benefits the other side because they acquire a valuable asset at below market price. Okay, and last but not least, if you are a listed company, you have to prepare quarterly financial statements every 3 months and also at the year end. Okay, and another important job of the audit committee is to nominate a person or person to be the external auditor. They are the people who will nominate. It's up to the shareholders during the AGM whether they want to accept or they don't want to accept. Okay, but the nomination with the suggestion, these are the people: Ernst & Young, KPMG, what they call KPMG, Pricewaterhouse, Deloitte, or maybe they go for second tier firm, BDO Binder, Grant Howard, okay, whatever firm. Okay, they just nominate. They nominate, is up to the shareholders whether they want to accept or they don't want to accept during the AGM. So this is what best practice in corporate governance. Best practice in corporate governance. Now, before appointing the external auditor, the role of audit committee has to evaluate the external auditor in the following areas. Do they have enough qualified staff to carry out the audit work? Okay, the partner or owner of the firm has sufficient experience in auditing big companies, especially if you're listed companies. There are a lot of regulations, a lot of requirements. Remember, every 3 months, they have to prepare the financial statement every 3 months. And they have a good knowledge on the rules, taxation, accounting practices. So you need to keep in mind, if some of you are going for internship, I see some of you posting in social media that you're going to be working in this firm, that firm, good for you, I'm happy for you. So make sure you have done your reading, okay? So when you go there, day one, you know what your supervisor, manager tell you what to do, you know what to do, okay? So auditing big company, good knowledge in rules, companies, what do you call rules, meaning company secretarial practice, company law 2016, and so on and so forth, taxation, accounting practices. And then very, very important, okay, I know this is something the external auditor, especially our interns, they're going to face the pressure, they're going to meet deadline as required by Bursa Malaysia and Securities Commission. So sometimes you will find those working in audit firm around the 30th June, before that, around that time, they'll be very busy. But some companies are preparing account to 30th of June. Some company are preparing account to 31st December. Okay, depends on the company. So around that time, the staff of audit firm will be very, very busy. Okay, sometimes they work until midnight, weekend, and so on and so forth. You can ask your friends. Okay, so able to meet the deadlines as required by Bursa Malaysia and Securities Commission. So how independent is the relationship of external auditors? Okay, external auditors are there to safeguard the interests of the shareholders, especially the minority interests, and are they objective in carrying out their work? Objective means they are unbiased, not biased. Okay, so how independent is the relationship of external auditor, and how objective are they in carrying out the audit? Okay, so they have to investigate any activities of the public listed company and seek any information they require from any employees directed to corporate. And then they have to seek outside legal independent advice, instruct internal auditors to carry out investigation and review financial control systems. Importance of audit committee is to enforce the independence of the company's external auditors, help to assure the auditor will have a free rein in the audit process, and provide a forum for regular informal and private discussion between external auditors and INETs, and have no significant relationship with the management, because we are going to make comments about the management. Okay, so hence external auditor raises potential troublesome issue relatively early stage, allows auditor to broach sensitive problems in an uninhibited private fashion, gives auditor assurance it can readily get a hearing in the event of a disagreement top management, and to reinforce the objectivity of internal audit department. So very important to have a working relationship with the audit committee to increase the status and effectiveness of the internal audit department. So this is the reason why it's very important to have an independent audit committee. So best practice, they need to meet often. Okay, meet often without executive directors present. Sometimes they are talking about them. Maybe we are discussing what they did, something they did funny, hanky-panky. So we must meet without them around. Okay, so basically we meet, the advice is to meet at least once a year, but good companies, they meet 3-4 times a year. Okay, so the finance director, head of internal audit, and representative for external auditor can also attend audit committee meetings. Other board members may attend but must be invited by the audit committee. So at least once a year, audit committee shall meet with external auditors at least once a year without the executive directors being present, and the performance should be evaluated by the board of directors. Time the meeting early to allow changes to figures and published financial statements. So there's enough time to make any changes to the published financial statements, and it's usual to have at least 3 to 4 meetings. At least 3 to 4 meetings to coincide with the audit cycle and the published financial statements. From time to time, you may have ad hoc meeting, okay, to discuss any particular issue that crop up. So it's not in our schedule, but it is called an ad hoc meeting to discuss special issues. Okay, this is the case of Enron. We will discuss it at length in previous classes. Okay, it's a very famous case. Okay, 2002 case. The board of directors failed to respond to warning signs. The CEO Jeffrey Skilling resigned suddenly without any reason, and then the new CEO took a hands-off approach. Kenneth Lee, an auditor, the auditor that time was Arthur Anderson. The firm is no longer around. The firm already closed shop because they, sorry to say, they colluded with the top management. Okay, so audit committee chairman did not investigate and question the high-risk accounting practices. And then the other problem in Enron, they avoided excessive remuneration to top executive, what they call as fat share option scheme, fat share option scheme. And directors were highly paid as much as US dollar 350,000 in cash, shares, and options. So there's plenty of information about Enron in the internet. Just Google. Okay, this is a very high-profile case. One of the major scandals happened in 2002. And this is a case that's happened in Malaysia. Okay, this is called Astral Asia Berhad. Directors of this company were publicly reprimanded by Bursa Malaysia for stating in their annual report that they held 6 board of director meetings in their financial report for the year ended 31st December 2004. They mentioned they had 6 board of director meetings. But when the Bursa Malaysia investigated, they found they actually had only 1 meeting, 1 board of director meeting. Okay, so they were publicly reprimanded by Bursa Malaysia. This would not be good for a listed company, because when they publicly remand you, that means reprimand you, meaning you're being named and shamed. You are being named and shamed. So surely you will have an impact on the share price. Our Malaysian people are very sensitive. You know, I think you all followed the case of Serba Dynamic when the news broke out that the KPMG refused to sign the audit report. They got many issues with the audit report. There are many reservations. They don't want to sign. Before it came out in the newspaper, official media, already in the social media came out already. Already came out in the social media. So all people started to, some of them started to sell their shares, and the price started dropping. Okay, so for a public listed company, if you're going to be publicly reprimanded by Bursa Malaysia, Of course, they will mention it in the media. So this is what they call name and shame. Will have an implication on your share price. Okay, so with that, I've come to the end. So I'm going to go back to the chat area in case there are any questions. So we have gone through 22 slides. As I've said before, these are the 3 important board subcommittees. Okay, I repeat, you need to focus on these 3 board subcommittees. The first one is the nomination committee. Okay, nomination committee. What is the best practice for the nomination committee? What is their job? What are they supposed to do? Basically, they're supposed to identify. They are supposed to identify ensure that the right candidate joins the board at the right time, the right skills, right knowledge, right experience. Meaning we get the proper candidate, and as well as to groom existing top managers for the CEO post. Don't wait for the CEO to resign, retire, just leave like that, and then suddenly you realize, oh, we don't have somebody to take over. So this, you need to have in place a proper board succession plan, proper plan. Meaning if so and so leaves, okay, this person will step up to the job. Okay, this is nomination committee. The next one is remuneration committee. These are the people who decide on the compensation package. It's a very, very sensitive area. Like I said, if you cannot pay too much, you cannot pay too little. You have to avoid excessive pay package for the executive director and CEO. So very important, you need to tie the remuneration to the performance. Okay. And last but not least, audit committee, as I said, it's legally required. Okay, legally required. So please go through all the slides. I will put in down times. Okay, this is very important, 3 board subcommittees. So also you can look at the case study. I mentioned the first one is Enron. I think we have gone through this at length. I've been mentioning this week after week. Okay, by now you should know already what is the issue in Enron. Okay, one thing you need to keep in mind, because of this Enron case study, Arthur Andersen, which was one of the biggest auditing firms in the world at the time in 2002, has now closed shop. You don't hear the name anymore. It doesn't exist anymore. Because why? Because they participated in this scandal. They colluded with the top management, so they lost their business. They had to close shop. Okay, and then the other case, which is a Malaysian case. This is quite an old case. If you want to talk about the more recent case, you can refer to Serba Dynamic. Okay, refer to Serba Dynamic. Okay, so now I'm going to go back to the chat area. If there are any questions, please put it in the chat area. Otherwise, I will just share the attendance link on CAMS. So you can take attendance. Just wait for the thing to come up. So in the meantime, if there are any questions, quick question, you can shoot it in the chat area and try and answer before we close up. But anyhow, I want to remind you guys that these 3 board subcommittees are very important. So take time to revise and go through the 3 committees that I've just discussed at length today: the nomination committee, the remuneration committee, and last but not least, the audit committee. Okay. Okay, you can do your attendance now. Okay, you can see the code in the screen. Please do it before the screen closes. For those who can't see it, then I'll share in the chat area as well.